Hi, welcome back to the Personal Finance course. I'm Tom Mihawk, and this is our chapter on stocks. What a big chapter this is. This one, everyone invests in stocks. Stocks are the way most people know we invest for the long term. And this chapter is going to talk about what stocks are, why we invest in stocks, why we have a bias for investing in stocks, particularly for the long term, and how to make good choices about them when putting together our own retirement savings, investment portfolios, and that sort of thing. So why do we invest in stocks for the long term? Take a look at these two charts. These two charts, one by Roger Ibbotson, published through Morningstar, and the other one by Jeremy Siegel, published in his book Stocks for the Long Run, show the impact of investing in stocks for the long term. The Ibbotson chart on the left shows us from 1926 to 2018, small stocks produced a compound annual return of 11.8% and large stocks 10%. And this is a higher return than any of the other securities shown here, government bonds and treasury bills, for example. Jeremy Siegel, in his chart on the right, shows that from 1802 to 2012, stocks have produced a 6.6% return. Again, higher than bonds, bills, gold. Both of these charts are important reasons, important ways to see why stocks are so important to invest in. Interestingly, I met both of these, the gentlemen. The Ibbotson chart used to be put together, it's Roger Ibbotson, and used to be put together with his partner Rex Sinkfield. And Roger went off on his own at some point. I met Roger once at a conference, and he's kind of scholarly. He has his own investment management firm. He teaches at Yale. He's been a successful guy in the investment and finance industry. Jeremy Siegel was interesting. I was at a conference, I think a Cigna conference in Scottsdale, and it was the first night of the conference. There was a barbecue, picnic tables around, and barbecue pit beef being served. And I was with my boss. We went to sit down, and this gentleman comes up and he says, "Hey, may I sit with you?" And he's sort of scholarly looking and professorial. He teaches at Wharton, University of Pennsylvania, and he's done a couple of books. And to his credit, too, he's made a great career for himself. He was a speaker the next day, and so we ended up having dinner that night on a picnic bench, eating probably barbecue with Jeremy Siegel. So both of these charts show why equity stocks should have a bias in your portfolios. Now let's take a look at them a little bit more. Large stocks in the Ibbotson chart produced 10% compound annual return for the period 1926 to 2018, 4.5% premium over bonds. And in the Siegel chart on the right, stocks produced a 6.6% annual return for the period 1802 to 2012 for a 3% premium. We call this the equity risk premium. The source is from the charts on the previous page. So, according to David Swensen, Swensen runs the Yale Endowment, is the chief investment officer of the Yale Endowment. He's not as well known as some other people like maybe Warren Buffett or maybe hedge fund people you may know, but David Swensen is very influential. In fact, his book that I used in some of the research is this here. It's called Unconventional Success, a Fundamental Approach to Personal Investment. And he lays out what he calls the elements of smart investing. Have an equity bias because even modest return differentials operating over long periods of time translate into staggering wealth differentials. Students in my personal finance courses know that because when we do the chapter on time value of money, we see the difference that even a small percentage difference per year makes for the long term. Small percentage difference, 0.5%, makes a huge difference over the long term. Diversification improves portfolio characteristics by allowing investors to achieve higher returns for a given level of risk or lower risk for a given level of returns. And awareness of taxes, the provision in the tax code that causes taxes to be due only upon realization of gains, allows investors to delay payment of taxes far into the future. These are quotes from Swensen from his book. I didn't write this. But the point is that what he's saying is that, and we're going to talk about what capital gains are in a minute, But what he's saying is that until you sell a stock, you don't realize a tax on the capital gain. And that delay of realizing the tax allows the stock to grow even more. The same is true in 401k plans and retirement plans. IRAs, for example, where when you don't realize taxes, the benefit accrues for a long period of time. So this deferral of capital gains taxes creates an enormous economic value to investors. So what are stocks? Stocks are partial ownership, which is equity. Equity is like the difference between the value of your home and your mortgage. That's the equity in your home. You take the assets of a company less its liabilities, and that's shareholder equity. That's the equity. That's the ownership of a company. So stock represents partial ownership in a company. With it, you generally get a voting right. Now, your partial ownership is not going to enable you to be able to call Tim Cook at Apple and say, "Hey, I don't like the iWatch. I think you should upgrade it or fix it." But it does give you a vote, and in collection, all the shareholders get a vote. Equity is a residual interest, meaning that value accrues to equity after others with superior claims are paid first, such as employee payroll, trade creditors, banks, and bondholders. Equity has the lowest rights in the event of a bankruptcy. When you look at a balance sheet, common shareholders are here, preferred shareholders come higher, high yield debt comes next, maybe subordinated debt, then senior debt, trade creditors. In the event of a bankruptcy, people who have the lowest residual interest have the least claim, and those with higher residual interest have more claim. But the higher residual interest gets paid less. Senior debt might be making 3 or 4% rate of return, where common stock we might look for 8 or 10 or 12 or maybe more % return. So the greater returns of stocks are accompanied by greater risk, which we see in the form of volatility, meaning up and down movement of share prices. Investing in a stock or equity means you could lose all your investment. No more, but you could certainly lose it all. Hopefully not, and making smart choices will help you not to do that, but you can. Companies issue stock to grow, to provide liquidity for early investors to be paid for the risk they took in starting the company. And there's no commitment to repay stock purchasers, as I just said. You could lose your whole investment. There's no commitment that you'll be paid back. So where do stock returns come from? Capital gains, which is the growth in share price. When stock prices go up, the current value of the stock less the purchase price is what's called capital gain. Capital gain is the difference between what you bought the stock for and what it's worth today. And it represents growth. And dividends also produce returns. They're paid out of earnings, which in a corporate situation is called net income. Just like in a personal cash flow statement, we have inflows less outflows equals surplus or deficit. In a corporate situation, we have revenue less expenses equals net income. Dividends help make a stock more attractive if capital gain expectations, meaning growth, is modest. If the company's not growing as quickly, dividends make the stock look more attractive. Dividends are not guaranteed, although companies rarely reduce or discontinue them unless they're in distress. They generally increase over time, some faster, some slower, but they generally increase. And they're paid primarily by older, larger, stable companies in stable industries. Companies don't usually commit to paying a dividend until they know they can continue to pay it. So stock returns come from increases in share price, capital gains, and dividends paid out of the company's earnings. So some types of stocks. Common stock is the most typical form. If a company has only one type, it's probably common stock. The highest return possibility among all stocks that are offered. Dividends are not guaranteed, as we just said a moment ago, and they usually have some form of voting rights. You have a common shareholding is a partial interest, a proportional interest in the ownership of the company. Preferred stocks, dividends are guaranteed. If they're not paid because the company's in some distress, they accrue and they're paid in the future. Voting rights vary. You may have voting rights, you may not. They may be callable. We'll talk about callable in the next chapter, the bond chapter. But in general, what it means is they can be asked to be returned so that the company can avoid paying them in the future. It has a superior position to common shares in the event of a bankruptcy. And there are classes of stocks. A and B are most common, and they generally describe having different voting rights. So the A shares may have 10 times the voting rights of the B shares. A very well-known example of this is Berkshire Hathaway, the company that Warren Buffett runs with his partner Charlie Munger. Warren Buffett runs it. Charlie Munger is kind of like his consultant. But the point is that the Class A and B are the most common, and the Class A shares generally, if there's two classes, A and B, the Class A generally have a superior voting right. Okay, some ways to categorize stocks. Growth and value. Growth stocks meaning growing faster, you pay more for them compared relative to $1 of earnings. And value stocks, meaning you pay less for them relative to $1 of earnings. I showed a description of these in the Investing Fundamentals chapter. The Morningstar chart where we showed on the left side were growth stocks and the right side value stocks. So you generally pay more for growth, generally pay less for value, but hopefully the gain opportunity in both is similar. Capitalization, large companies, mid-sized companies, and small. Remember, capitalization is shares outstanding times the market price, and it's a proxy for the size of the company. Dividends and income stocks. I was looking recently at Exxon. Exxon pays something like a 7 or 8% yield. This means the amount of the dividend on an annual basis relative to its share price. That's attractive in a, you'll see this at the bottom, blue chip stock. Safe-ish, large, huge company, one of America's largest, probably 10, in a stable industry, although oil prices certainly can change, and it can change over time. New issues. Everyone was excited a few years ago about Facebook. New issues some people think offer great opportunity when they first come out. Defensive stocks are good to own when the economy is bad, for example. Cyclical stocks go up and down with the economy, maybe like airlines, for example, or maybe travel and leisure companies as an example. Blue chip stocks are, I guess in gambling, a blue chip is meant to be safe or valuable. Blue chip stocks are ones that are well known in stable industries. And then lastly, you might describe a company by its industry, like technology or pharmaceutical stocks, financials or consumer goods companies. And these stocks behave similar to the way their industries behave. So that's our last slide in this first section of our chapter on stocks. I'm Tom Mihawk, and I'll see you in the second section shortly.